Stock market overview. So you want to invest in the stock market. First, you need to understand the stock market is legalized gambling. Second, it is driven by emotion and greed and not logic. Since its inception and over time, the market and its three major indices have continually increased. Now, that doesn't mean there have been periods of corrections, because there have been many, with some being more severe than others. So let's go over the three major indices that investors focus on. First, the Dow Jones Industrial. Second, the Nasdaq Composite Index. And third, the S&P 500. First up, the Dow Jones Industrial. The Dow Jones is comprised of 30 large prominent companies and is comprised of mainly non-tech companies, but does consist of Apple, Microsoft, and a few other tech companies. So let's take a look at a historical chart of the Dow to get a sense of how the index has performed over time. Now, let's talk about the Nasdaq. The Nasdaq is primarily comprised of growth and technology companies such as Amazon and Nvidia, and was formed in 1971. Now let's take a look at its historical chart to get a sense of how it has performed. And finally, we have the S&P 500. The S&P 500 consists of 500 companies listed on the New York Stock Exchange and is to be reflective of the composition of the U.S. economy, and it was created in 1957. Now let's take a look at its chart. When these indices rise, generally speaking, the value of those companies in the indices rise, and thus more wealth is gained for the investors in those companies. In time, where it falls, the inverse happens and the values of those companies decline and wealth is lost. As one can see with these charts, the market basically went straight up from 2009 to 2021. This is because stock prices are based on supply and demand economics. The more money and buyers the market has, the greater the stock prices will be. If there are more sellers than buyers, then stock prices in general go down. Hence, when the Federal Reserve artificially kept interest rates low and then pumped trillions into the economy from its quantitative easing policy, along with all the COVID money that Congress gave out, it gave investors few options to invest in for good returns other than the stock market, because the returns on those other investments did not yield much. When interest rates increase, other investments such as bonds and savings accounts rates will give investors other options for decent returns, so people will pull money out of the stock market to invest in other places, and thus the market should go down as seen in 2022.